Hello, everyone. Welcome to the Financial Mini Lecture. According to media reports, in December 2023, the world's largest luxury e-commerce platform, Farfetch, faced a bankruptcy crisis. Its share price continued to plunge over several months, collapsing from a peak market capitalization of $26 billion to just $250 million, wiping out more than 98% of its market value. When such news appears before us, it is no longer merely a piece of financial headline news. Please take a moment to think, what kinds of ripple effects might this event generate? The first chain, thousands of employees of the company may worry about their jobs and salaries. The second chain, hundreds or even thousands of supplier firms may face difficulties in recovering their payments. The third chain, pension funds and ordinary investors around the world holding its stocks or bonds may see their assets shrink dramatically. Now consider a simple question. Apart from these directly related parties, who else might be indirectly affected? What if your friend works there? Or what if your city hosts one of its branches? Those involved could be anyone around us. This is precisely the most prominent feature of financial risk, contagion. It never exists in isolation. Instead, it always propagates through the intricate networks of the modern economy. So, can risks be managed, or even transformed from danger into safety? Today, let us explore together this discipline of stability and wisdom, financial risk management. When facing risk, whether for multinational corporations or individual households, panic is of no help. What we need is a systematic approach. This approach can be summarized into 4 interlinked steps, known as the 4-step method of financial risk management. Step 1. Risk identification. Just like a ship sailing at sea, we must first identify where the leaks might be. This is the foundation of risk management. For enterprises, key questions include: will the prices of our raw materials fluctuate? This is market risk. Will our customers be able to make payments on time? This is credit risk. Could our computer systems be subject to cyber attacks? This is operational risk. For individuals, the questions might be: is my job stable? This is income risk. Is my investment portfolio overly concentrated? This is investment risk, and so on. Step 2. Risk assessment. In other words, determining how large and how deep the leak is. After identifying risks, we must quantify them. How likely is this risk event to occur? If it does occur, how severe would the potential loss be? We need to distinguish between high-frequency, low-loss issues and low-frequency, high-loss, catastrophic threats. Step 3. Risk response. Choosing how to repair the leak. After assessment comes decision-making. There are typically 4 major strategies. Avoidance, completely staying away from high-risk activities, such as refraining from speculative investments that one does not understand at all. Mitigation, taking measures to reduce the probability or impact of risks, such as conducting background checks to lower the bad debt ratio. Transfer, shifting risk to a third party, with the most typical example being purchasing insurance. Acceptance, after careful evaluation, proactively setting aside funds to absorb potential losses, such as enterprises making provisions for asset impairment. Step 4. Risk monitoring. Continuous inspection and early warning. Risk is dynamic and constantly evolving. Therefore, it is essential to establish a continuous monitoring mechanism, revisiting and adjusting the previous 3 steps in response to changes in internal and external environments, thereby forming a closed-loop management system. Now, let us do a short exercise. If you plan a long-distance self-driving trip and decide to purchase roadside assistance services in advance to manage the risk of vehicle breakdowns, which step of the 4-step method does this action correspond to? A. Risk identification. B. Risk assessment. C. Risk response, transfer. D. Risk response, mitigation. The correct answer is C. Risk response, transfer. By paying a fee, you transfer the risk and responsibility of seeking help after a vehicle breakdown to a professional rescue company. This is how financial risk management thinking manifests in our daily lives. With the 4-step method as our map, let us now examine 3 dramatic yet insightful real-world journeys. Case 1. Risk resolution of Anbang Group. This can be described as an orderly bond disposal operation. In 2018, Anbang Insurance Group, once holding nearly 2 trillion renminbi in total assets, was taken over by the former China Banking and Insurance Regulatory Commission due to serious risks such as false capital contributions and illegal operations. This was not the end of the story, but the beginning of a classic case of risk resolution. Precise identification and assessment. The regulatory task force acted like top-tier physicians, swiftly completing a comprehensive diagnosis. The core conclusion was that corporate governance had completely failed, and self-recovery was no longer possible. Systematic response. Instead of opting for simple bankruptcy liquidation, which could have triggered market panic and policyholder runs, the Chinese government adopted a complex and refined surgical procedure. Takeover, asset disposal, business divestment, introduction of strategic investors, establishment of a new entity. Key monitoring and outcomes. The entire process was smooth and orderly. Most importantly, 100% of policyholders' legitimate rights and interests were fully protected, with no overdue payments. The original insurance business was fully taken over by the newly established Asia Insurance Group, achieving a soft landing of risk. This case shows that for systemically important financial risks, the highest level of management wisdom lies in safeguarding financial stability and public interest through professional and orderly intervention, resolving major risks within the system itself. Case 2. Thailand's rebirth after the 1997 financial crisis. The Asian financial crisis of 1997, which began with the depreciation of the Thai baht, stands as a painful lesson in financial risk management failure. Thailand's problems stemmed from the policy combination of a fixed exchange rate and free capital mobility, like a reservoir without floodgates that collapsed instantly under speculative capital attacks. At the time, risk identification lagged severely, and risk assessment was grossly inadequate. The domestic financial system was fragile, and large volumes of short-term foreign capital flooded into a real estate bubble. After the crisis, Thailand undertook profound financial reforms, representing a major management upgrade. Abandoning the fixed exchange rate in favor of a managed floating exchange rate, allowing the exchange rate to act as a shock absorber. Accumulating substantial foreign exchange reserves to provide economic ammunition and confidence. Strengthening financial regulation by adopting international standards, raising bank capital adequacy requirements, and establishing a stricter macroprudential framework. Thailand's experience shows that, at the national level, the key to risk management lies in building a resilient system. Such a system must learn from crises and, through institutional reforms, install automatic fire doors and pressure relief valves for the entire financial system, thereby constructing a national financial firewall. Case 3. The collapse of Lehman Brothers. In 2008, Lehman Brothers, a Wall Street investment bank with a 158-year history, collapsed, becoming a symbolic event of the global financial crisis. Its downfall was not due to worthless assets, but rather to one of the most classic financial risks, liquidity risk. Lehman's business model relied heavily on short-term market financing to support massive long-term assets, such as subprime mortgage-backed securities. This was akin to constantly borrowing new money to repay old debts. When market confidence in its asset quality evaporated, financing channels froze overnight. The firm lacked sufficient cash or highly liquid assets to meet maturing obligations. Within the four-step method, Lehman severely misjudged the probability of an extreme, funding disruption scenario, a failure of risk assessment, and had no effective contingency response plan. The lesson shocked the world and accelerated the introduction of Basel III, which mandates that globally significant banks hold sufficient high-quality liquid assets to withstand extreme stress scenarios. This case serves as a warning to all market participants: never ignore the most fundamental risks. Even the most brilliant performance can be destroyed instantly by risk. Respect the market, and always prepare a safe escape route for yourself. Let's review the core content of today together. 1. Framework. The four-step method of financial risk management: risk identification, risk assessment, risk response, and risk monitoring. 3 major insights. From Anbang's resolution, we see top-level design guided by responsibility and wisdom to maintain overall stability when major risks erupt. From Thailand's reforms, we learn how an economy can build long-term resilience through institutional innovation after trauma. From Lehman's collapse, we realize that both individuals and institutions must maintain eternal respect for the most basic risks. There is no absolutely risk-free haven in the financial world. But excellent risk management allows us to navigate storms with greater composure and less panic. It is not merely a technical skill, but a mindset of foresight and rational self-restraint. May we all become clear-minded and steady captains on our own financial voyages. Thank you for watching. See you next time.